the second in this IMAP webinar series on property and infrastructure, and whether they offer defence in uncertain times. And my word, what uncertain times we are living through at the moment. The session today is going to focus on infrastructure, and we're lucky to be joined by two very experienced infrastructure investors who I'll introduce in just a moment. My name's Toby Potter. I'm the chair of IMAP, and it's our pleasure to host this webinar series for you. Before I introduce our speakers, let me just mention next Friday's session. In these series, what we try to do is address on Monday and Wednesday each day the topics in some considerable detail, and you'll see that today we really are going to get into a good deal of detail about the infrastructure area. And then on Friday's sessions, we try to wrap it up from a portfolio management approach. And this Friday, we're lucky enough to be joined by two of the larger advice-oriented portfolio managers, Matthew Swakonic from Findex and William Morgan from Atrium, who will talk about the role of property and infrastructure in their approaches to portfolio management. And we'll be canvassing in a portfolio management sense a little of the detail that we're going to talk about today, specifically in regard to infrastructure. I'd encourage you to ask questions, and believe me, there will be questions in your mind. And so use the Q&A button to send through those questions. Format of today's session is that initially I'm going to invite Justin Lannen to talk about listed infrastructure. Justin is the co-founder and portfolio manager for Maple Brown Abbott's global listed infrastructure strategy. Maple Brown Abbott are involved with today's webinar series because of their relationship with Ironbark, a long-time IMAP sponsor and a valuable sponsor and a key participant in the managed account space. Justin, prior to joining Maple Brown Abbott, was a portfolio manager at Macquarie, obviously one of the most influential and initial investors in infrastructure assets in Australia. Then I'm going to invite Mark Murray, who is a principal and portfolio manager from Mercer's, to talk about their unlisted Aussie dollar denominated hedged infrastructure portfolio. Mark, like Justin, has a lot of experience in this area, and he's responsible for sourcing and managing infrastructure and other real assets for Mercer for their investments throughout the Asia Pacific region. So now it's now an opportunity for me to invite Justin to talk about infrastructure and the listed approach to infrastructure investing. Justin, over to you. Thanks very much.
Fantastic. Thank you. And it's good to be here today to talk about the listed infrastructure strategy that myself and my partners manage at Maple Brown Abbott. So I might just turn the page, please, and do a bit of an introduction to how we define infrastructure. Well, infrastructure for us is very much about finding businesses that are or assets that provide essential services to the societies around the world. So within those essential services, we're looking at things like roads, airports, water, electric grids, renewable energy, and so forth. And the defensiveness, which I'll expand more on very shortly, within infrastructure is very much coming from those essential services that people continue to use in good times and bad. And this also helps explain not just the defensiveness, but also the relatively low correlation to other asset classes, which is obviously useful for when constructing a portfolio. So the assets that we're looking for within the infrastructure space, they all have similar characteristics, even though they provide very different services. And those characteristics are strategic positions in the economy, monopolistic type behaviour, and lack of substitution. And also for most of these infrastructure assets, a lack of substitution or risk from technology as well. The businesses tend to have pretty stable cash flows in good times and bad, and also relatively predictable growth many years out into the future when we forecast out what the earnings are. And another feature with that predictable growth is that the cash flows tend to grow in real terms. That is, inflation tends to be a pass-through. So the inflation protection in infrastructure is a real feature of the asset class as well. If I can turn the page. So we manage money for clients around the world. We only do listed infrastructure, but one thing our clients, I think, come to us for seeking in the asset class is that lower volatility coming from the defensive cash flows. We always talk about volatility rather than share price or portfolio volatility. That's interesting. But when we look at the infrastructure assets, we look at the volatility of the cash flows coming off to us as an owner of the business on a post-gearing basis. So we want to have, obviously, balance sheets in good shape there, because if you over-gear a stable income stream, then that can actually become volatile, particularly in rising interest rates, which we've seen lately. So we love income stability. We love the inflation protection embedded in the roads and the regulated infrastructure assets, where inflation has passed through to the users in a timely fashion. And also, a lot of our investors like the portfolio diversification that comes from adding an infrastructure exposure to their other exposures in different asset classes. And probably the thing that gets me excited as an investor is the different mega themes that we can access as an infrastructure investor. The really big themes that we see and invest in at the moment are big themes of our time, such as decarbonisation of the energy systems, digitalisation with communications infrastructure, transport mobility, water security and pollution reduction from wastewater. All of these themes are big themes at the moment and will last for many years into the future, and also require a very large amount of investment, which some of the clever companies that we invest in are actually able to position themselves well to get good long-term returns from these mega themes. If we could turn the page, please. One of the things that is important to us in accessing that good definition or that tight definition of infrastructure to get the attributes is excluding assets within the infrastructure space that I would describe as peripheral infrastructure assets. So these assets tend to maybe they don't have the good inflation protection. Maybe they're a little bit competitive or exposed to commodity markets. So we screen out a lot of companies like seaports, railways, above rail as we call them, which are a little bit competitive in nature against trucks and other railway systems, and also integrated utilities as we call them. So anything with sort of market-based pricing for electricity or gas power generation that's not under long-term contract or regulation, we exclude those companies because they're just too volatile and too uncertain. That's not really what we're trying to achieve with our infrastructure strategy. And also, technology does change things, particularly in communication infrastructure, not so much a lot of the other sectors, but for example, satellites, we exclude those just because nowadays there's lower barriers to entry in satellites. The contracting's a lot shorter and the earnings are a lot more volatile. So we used to think satellites, for example, were infrastructure until about 2015, but now we exclude those. And within communications infrastructure, we only include cell towers, which are very good examples of an infrastructure network that you really can't get around in terms of providing that essential service to society. Just turning the page now, we'll talk a little bit about the defensiveness that the asset class can provide. And all of these numbers here are with probably the best infrastructure index, in my opinion, being the FTSE Core 50/50 index. And all this chart simply does is it looks at global equity returns. This is all in US dollars, not Australian dollars, going back to the end of 2005. And we've just looked at the calendar quarters and said, was the return negative or was it positive? And we've just looked at all the negative returns, those quarters where global equities have gone down. And what did infrastructure do? And also, whilst we're at it, we looked at what did REITs or property trusts do. So infrastructure typically in down markets for global equities does better, not all the time. No asset class can do better all the time. But infrastructure, go back to 2005, in 15 out of 20 downturns for global equities, those downturn quarters, infrastructure's done better. So it's a 75% hit rate, which is a lot better than REITs, which tend to be more highly correlated to global equities than infrastructure is. So in this way, you can see that infrastructure is a lot more defensive in down markets. And that kind of makes sense, doesn't it? Because the top lines or the earnings of these businesses are a lot more stable. And the flip side of this down market, and we've seen this a bit this year with global equities being very strong, in a very hot equity market, infrastructure tends to participate, but it doesn't tend to be 100% participating in bull markets for equities. And I'll come back to that theme. I think it's quite interesting at this point in time exactly. So I might just take a minute to talk about some of the investment themes that we have at the moment within our portfolio, and we spend a lot of time looking at and meeting regulators and companies involved in these sectors. But just to pick a few, US regulated electric utilities. US is the biggest market for renewable development and grid modernisation to support the renewables. The US market's a massive market, obviously, with a lot of infrastructure money being spent into the grids and to roll out renewable power. Very supportive tax incentives are available now. The Biden government made sure of that last August, that probably until about 2040, there'll be good tax incentives for investment into renewable, solar, wind, and other associated technologies. So there's a lot of growth that we're seeing in the US electric utility space, particularly electric, because another view we have is that the world is electrifying itself as it gets off fossil fuels. Electric utilities will benefit and grow a lot faster than, say, gas utilities or other types of energy utilities. So a good long-term trend to invest into there. Another theme that we're invested in at the moment is UK water infrastructure. So what we see with regulation is that every country has slightly different regulation, and our job is to understand that. But UK water infrastructure is looking very interesting at the moment, with probably a 20-year cycle of investment to take place to reduce pollution from wastewater coming up, we think. So these UK water infrastructures are monopoly networks. They're all regulated and they have a very timely inflation pass through to the asset basis, which means future earnings are immunised for inflation increases, which has been very important recently with the very high UK inflation that they've been experiencing over there. Transport mobility is another big one. Transport, people are travelling again post-COVID. So the roads in most places and a lot of airports as well are back above, with volumes above what they were in 2019 pre-COVID. So we invest in roads, airports, Channel. One other interesting concession we invest in is the Channel Tunnel, or the GetLink infrastructure between England and France. So we typically see on those assets traffic and pricing growth as well. Renewable energy development, another big area for investment that some of the utilities are doing, and some of the pure play utility companies are investing into wind, solar, offshore wind. These types of assets that can often be put under regulation or long-term contracting with tax subsidies on top of that in some countries. So that's another interesting area. Digitalisation, data usage across society on our phones are still growing at over 20% per annum. So we're seeing big investment into the digital network infrastructure. We like the cell towers, in particularly in Europe and the US. And they've actually, interestingly, been very weak with the interest rate increase that we've seen over recent years. So that's been another theme. And another theme that we see is that, and Mark will talk a little bit about the unlisted infrastructure, but we do see some of the listed infrastructure companies able to recycle assets to the private markets at sometimes at a good price as well. Just turning the page, please. For us, the big thing that we see is the big investment taking place, and long-term theme here, into infrastructure. Around the companies we look at in the infrastructure space, around 10% of their market capitalisation is being invested into new infrastructure enhancements. So that's a lot of investment going into monopolistic assets for what we think are attractive rates of return in a lot of cases. So so this trend is a long-term trend, and we expect across those different mega themes for that to continue for years into the future in this long-term asset class. And maybe just to finish up by talking about valuations on the next. Oh, sorry, interest rates. I should mention that, of course. Interest rates have obviously gone up a lot over the last 2 years. The way we think about interest rates is not to worry about the cash rate, but to look at the long-term rate in the country that we're investing. Largest country we invest in is the US. So we're looking at the US 10-year rate, which has actually spiked up over the last 3 or 4 months to above 4.5%, as you can see on this chart, top left. The way that I look at interest rates is to look at the real component of the interest rate and also the inflation component of the interest rate. So the real interest rate increase, that's the one that is a headwind or negative for infrastructure and a lot of risk assets or long duration assets. The inflation component of an interest rate, that doesn't tend to worry us so much because of the inflation pass through. So the real interest rate, you can see on the bottom left there in the grey, on the grey line there, as measured by the US 10-year TIPS yield. So that's gone up above 2%. Basically, it's gone up recently because the US economy has been stronger than anyone thought it might be at the start of the year. So real interest rates are a headwind. Keep that in mind. And then the inflation, break-even inflation rate. Inflation is obviously moderated and the expectations have come off a touch over the last year or so. But inflation as a pass-through doesn't tend to be such an issue. If we just turn now to the infrastructure markets versus global equities, you can see on the next slide that infrastructure has derated quite a bit actually versus global equities. And all this chart is the ratio of the listed infrastructure universe that we look at. We call it the focus list divided by global equities multiple, EV/EBITDA multiple. And you can see that with global equities being very strong over the last 12 months, infrastructure has derated. And actually, when we work out the earnings growth that we've seen over the last 12 months in infrastructure versus global equities, infrastructure has actually had more earnings growth than global equities. So that's actually helped or made the derating even greater in size. And if we turn to the next page and have a look at the numbers in global infrastructure versus global equities, you can see here there's a 22% differential in terms of global equities versus infrastructure over the last 12 months. A lot of that's been driven by technology in the US. Obviously, that's been a hot market. But when we distill that out, it's about 38% of the difference can be explained by artificial intelligence, tech boom type stocks. The rest of it's other types of global equities. So infrastructure at the moment looks cheap, just looking at these multiples and recent performance versus global equities. So that's throwing up some interesting opportunities for some of the sectors that we're looking at in listed infrastructure space. So with that, I might hand back to Toby and Mark to talk further about the infrastructure sector.
Thanks very much, Justin. That's a fascinating introduction. Now, there's a couple of questions have come through already, and I'll hold off on those. Some of them speak specifically to the points which Justin made a moment ago about valuations and performance. But we'll save those until the next part of our session today. So, Mark Murray from Mercer, over to you.
Thank you, Toby. Good afternoon, everyone. So unlisted infrastructure is an important investment opportunity for investors who can accept levels of illiquidity within their total portfolios. If we move to the next slide, types of assets that are typically classed as infrastructure are electric and gas utilities, communications assets such as towers and data centres and fibre networks, water and wastewater utilities, transport infrastructure such as airports, seaports and toll roads, and also social infrastructure such as schools and hospitals. And this is by no means an exhaustive list. I guess all that said, for investors, I think a more important way of looking at infrastructure is than the specific activities and assets that I've just talked about are the key characteristics of infrastructure investments that we've described here at the bottom of the slide. Infrastructure assets provide essential services that users frequently rely upon. Assets are protected from direct competitive pressures by high barriers to entry that preclude or inhibit other market entrants from directly competing. And those barriers for entry to the market, for example, are a direct regulation, such as applies to energy and water utilities. And for another example, the concession terms that govern many transport assets and preclude, for example, another road competing directly with a toll road that's established under a concession. So if we move on to the next slide, we define investment opportunities in infrastructure in terms of their expected returns and risk profiles, and then according to the sort of labels and categories that we've described here, ranging from core through core plus, as we call it, to value add to opportunistic, with a gradually increasing level of return expected and risk associated as well. A diversified unlisted infrastructure portfolio will often be invested in assets that together or collectively fit more than one of these profiles in order to deliver a combination of downside protection as well as a sufficiently attractive overall expected portfolio return. Potential expected returns are quoted here for each level of risk that we focus on. Infrastructure investment portfolios are commonly dominated by equity investments, but debt attached to infrastructure assets, or in other words, investments that are a little higher up in the capital structure of a given infrastructure asset, also forms part of the potential investment opportunity set within infrastructure. And within the debt sphere, there is again a range of risk profiles, I guess as suggested by the relatively wide range of potential returns quoted here of 4 to 10%. And the range is characterised, for example, at the one end by senior secured debt that is relatively low returning, as well as higher risk subordinated or junior debt that would sit just above equity in a company's capital structure. So if we move on to the next slide, unlisted infrastructure investing is, and I guess the market functioning is markedly different to the listed infrastructure space. Unlisted infrastructure is characterised by fundraising periods and a cycle to those fundraising periods. At any time, there are fund managers who are seeking to raise closed-end funds during a defined period of time that may, for example, extend from 1 to 2 years before that fundraising period will close. There are also other open-end funds that have the potential to seek new investor capital commitments on a continuous basis. These funds are commonly restricted to investors who can each commit upwards of $10 to $20 million to a given fund. Funds raised will then be gradually invested in a portfolio of infrastructure as and when the asset manager or the fund manager requires its investors to actually contribute the capital they have already legally committed. So in other words, there is a slower process, a more gradual progression for an investor to become invested in the unlisted infrastructure asset class than there might be to invest in listed infrastructure. 2023 has been a much more difficult fundraising environment for unlisted infrastructure fund managers, and the chart here illustrates just the extent of it gives an indication of the level of difficulty that they're experiencing, perhaps relative to previous years. And this is due to factors including higher risk-free interest rates that make, for example, fixed income investments potentially more attractive relative to infrastructure than they might have been previously. There's also been the effect of public market volatility over the past couple of years that has, I think, had the effect of reducing the amount that investors in this year could potentially commit to illiquid assets alongside perhaps their more liquid investments. Now, it certainly may be the case that there will be some catch-up in the level of fundraising over the second half of the year, or the half of the year that we're now in. I guess per this slide, there are still many managers seeking to raise capital right now across many funds. And it remains to be seen, obviously, how successful they will be in each case. So if we move on to the next slide, I guess as Justin discussed, infrastructure, and including unlisted infrastructure, tends to be quoted in terms of enterprise value to earnings before interest, tax, depreciation, and amortization. That's I guess a commonly quoted metric for comparing pricing and across sectors and assets and markets. Transactions in the unlisted market generally involve much larger single shareholdings than most trades that occur in the listed market. And consequently, this is a factor explaining some of why the unlisted market generates higher pricing multiples, pricing levels than the listed market might. The larger shareholdings commonly transacted in the unlisted market come with information access and decision rights, for example, that are valuable and that can support higher transaction pricing in the unlisted market. At the same time, it's also commonly much easier to directly observe current pricing in the listed market than in the unlisted market, where transactions in any single company will occur much less frequently. And transactions in the unlisted market are also not subject to the same disclosure rules in the listed market. So that's an additional factor making observation in the unlisted market just a little bit more difficult. If we move on to the next slide, environmental, social and governance, or I guess as an overall term, sustainability considerations are very important to infrastructure investment performance, alongside purely financial factors that drive investment performance. Infrastructure assets are critical and touch many people's lives on a daily basis. Consequently, they attract the regular interest of authorities such as governments and regulators. And key factors from an investor perspective are ability to implement economic pricing for an infrastructure asset services, such that the investors will generate an acceptable return, as well as being able to expand and grow an infrastructure asset, perhaps in line with the business plan or in line with the investment case that's been identified by the shareholders. And for example, an ability to implement pricing that's appropriate and to grow the business such as I described are factors that rely on continuing goodwill and support from a wide range of stakeholders, such as users, regulators, politicians, other people who may have a sort of peripheral interest in a given asset at times. And each of these stakeholders will have their own perspective on a given company or infrastructure project that may or may not necessarily align with the financial interests of shareholders, but nonetheless, their perspectives are very important for achieving the outcomes that are important from a shareholder perspective. If we move on to the next slide. So previously, I referenced fundraising periods and cycles. This chart here plots after fee internal rates of return reported for many infrastructure funds that were raised in each of several years. So, for example, at the right-hand side of the chart, this is showing the reported returns quoted recently by managers for infrastructure funds that they raised in the 2017 calendar year. And the spread of outcomes across funds raised in each year, I guess illustrated by the vertical spread, and as well as the variation in the median outcome across years, I guess illustrated by the purple dots that are perhaps identifiable on the chart. Illustrate that on the one hand, fund selection is very important. It's important to be invested in the better performing funds. And it's also important to be able to invest on a consistent basis through time, so as not to be particularly exposed to for example, a vintage or a year that may in reality, with the benefit of hindsight, turn out to be less attractive than some other vintages. So in other words, it's important, we think, to be invested in a diversified portfolio of unlisted infrastructure investment opportunities, and to continue to maintain that diversification through time, rather than, for example, to be invested in a single fund that might have been raised in a single year. And we think that's an important part of, or key, in fact, to generating an infrastructure investment return that would be sought after by investors. So that concludes my comments there. I'll turn it back to Toby.
Look, thanks very much, Mark and Justin. Justin, you're on mute, so let's turn to some of the questions that have come from the audience. And in fact, let's go back to talking about performance, since we've got this slide on the screen now. There's a question which has come through which says, you know, what has been the cause of recent underperformance from infrastructure investments of both listed and unlisted types? To either of you.
Yeah, I'll jump in first. So we particularly saw in the listed space, we did see weakness in particularly in the September quarter. Portfolios were off 5 to 6% in the quarter. The cause of that solely really is the increase in interest rates, or in particular the real interest rates. If we looked at that chart that I showed before, real interest rates have gone from about 1.5% to just over 2% in the US. That's always a headwind. So now where we're sitting in listed space, rolling 12-month returns are around flat. So that has erased a lot of the returns. We think, I'll probably just chip in with one extra point. We think the long-term objective of the listed infrastructure asset class, and we hope to do a bit better as an active manager, of course. We put it out to our clients that the long-term objective is OECD inflation plus 5.5%. That's the type of return that this asset class should have through the cycle. But certainly, recently it has been interest rates being the headwind in returns.
Mark, your last chart showed, if I understood it correctly, recently reported performance for funds that had been commenced over quite a range of years. I think 2009 to 2017. So sort of an over 10-year rate of return. It showed sort of around about 10% median returns. So is that something which you would counsel a medium to long-term investor to sort of think in terms of for a diversified infrastructure fund?
Yeah, so for example, the fund that we manage directly, we're on the portfolio manager for, has a performance objective of Australian CPI plus 5 to 7%. So in other words, we quote a range rather than a specific point. And I guess until recently, that would have been sort of approximately perhaps consistent with a return of close to 10%. Now, obviously, that's in recent times, inflation's been a little bit higher than what it was, so that's accordingly pushed up the performance objective. But it's also, I guess, as Justin was discussing previously, it's reasonable to expect, and we do expect that the CPI and inflation protection that the asset class enjoys means that indeed when CPI outcomes are higher, as they have been, that investors should expect to see an accordingly higher return to compensate them in real terms.
And so to listen to both of you, I mean, the sorts of return expectations are approximately equivalent. Inflation plus sort of 5 to 7%. What about volatility though from either type of investment, or either approach to investment, listed versus unlisted? Do you?
I think in terms of the unlisted market, perhaps it's certainly the case that assets are revalued less frequently than in the listed market. For example, in the unlisted market, it's common for assets to be revalued on a quarterly basis, or sometimes perhaps less frequently, or as infrequently perhaps as annually. I guess all the assets within in the portfolio that we manage directly are revalued quarterly. I guess that inevitably leads to a slightly lower volatility measured depending on exactly how it's measured. But I guess notwithstanding all that, I guess to a point that Justin was making previously, certainly within the unlisted space, infrastructure has been affected by increases in interest rates. It doesn't enjoy quite the upside in a bull market that other companies and assets might. And so that's had some effect on valuations of infrastructure assets in the unlisted space. But over the long term, I think the outlook or the defensive positioning of infrastructure assets means that we expect that infrastructure investment outcomes will be perhaps less volatile than what you might see from some other parts of the equity investment universe.
And so, I mean, we've now, I mean, when I think back to IMAP's portfolio management conferences of a couple of years ago, the phrase was lower for longer. We've now moved to the inverse of that in higher for longer. Do you think that this change of sentiment about the cost of long-term debt will have a material effect, Justin, particularly in the equity market, which seems more sensitive to this?
Yeah, so this is where it gets interesting. So every infrastructure company has different sensitivities, quite different sensitivities actually to the interest rates. So once again, if we break out the real and inflation-linked component, the inflation one normally gets passed through. But then it comes down to the type of asset. So we look very closely. Most infrastructure companies, because of that predictable cash flow stream that we can see, usually the lenders, the creditors will see the same cash flow, and then allow the companies to borrow a lot further out, and also a lot of fixed debt. So infrastructure companies will have a very high, almost not quite 100%, but 80 to 90% fixed debt is quite common, and that debt maturity could be sort of 6 to 10 years, something like that. Indeed, Transurban's a good example in the Australian market. That's the only Australian stock that we own. Their average debt maturity is between 8 and 9 years, and a lot of that's fixed rate debt. So it takes a long time for that to be passed through. And when you think about a company like Transurban, all the tolls, or pretty much all the tolls, are linked to inflation. So if we have a higher for longer scenario, those tolls get pushed up by inflation. That's how the contract or the concession works. Probably the other thing is that around 50% over time, if the assets will invest in what we call those regulated assets, which are natural monopoly water businesses, electric, gas grids, this sort of thing. And depending on the country a little bit, but for example, in the US, that big opportunity that I spoke about, that the debt is normally just a straight pass-through. The debt costs are a straight pass-through to the users of those utilities. It's a bit different in Europe and in the UK, where we have other assets, but typically if they're about half the portfolio, they can just pass the debt cost through to the customers. So there's a lot of different ways that the returns are immunised against rising rates. But us as an active investor, we kind of see that as an opportunity to sort of sort the companies out in terms of the sensitivity and what really is happening on the balance sheet when rates rise. So that's something we spend a lot of time analysing.
These are essentially illiquid long-term investments. So Mark, I mean, one of the things which I'd like to understand better is, as an unlisted investor, using managers investing in specific assets, what are the risks associated with placing retail investors' money, and we'll come back to one of the questions which has come through in just a moment, into investments that are essentially illiquid, without the sort of intermediation of the market?
Yeah, so I guess the key point, or the first point to make, is that I guess when we talk about illiquidity, what it means is that an investment in unlisted infrastructure will generally be unable to be exited or liquidated within, say, a quarter, or unable to be liquidated perhaps without penalty over, for example, or within, say, for example, 2 to 3 years. So that means that I guess if for example, a retail investor might expect to be able to liquidate their investment portfolio if they need to at relatively short notice, actually it would be difficult or not possible to do that within the unlisted infrastructure investments that they might hold. I guess that is an evolving space, right? So I guess historically it's been very difficult for an individual investor to invest directly into unlisted infrastructure. I guess more recently, and at the moment actually, we're seeing, I guess, occasional or more frequent examples of fund managers, in some cases perhaps relatively well-known fund managers, who are designing vehicles and investment funds that would accommodate slightly enhanced liquidity terms for individual investors who, at least indirectly. So, for example, I'm thinking of funds that might still apply a $10 or $20 million minimum to a given investor's minimum allocation, but they might now allow for example, for a financial advisor or financial or aggregator of retail investors to perhaps collectively contribute that 10 or 20 million, for example.
So does this mean, for example, that an advice firm that focuses on wholesale or higher net worth investors can effectively organise a placement?
That's right. So if they can aggregate a figure of, say, $10 or $20 million in total, then they could potentially be accepted by some unlisted infrastructure funds, but still with the understanding, or the terms applying, that that investment would either not be able to be liquidated within, say, a 2 to 5 year period initially, or if it could be liquidated within that time frame, it could only be liquidated at a discount to the prevailing NAV, such as it would be at that time. So they'd still be factors that are important to know.
Let's talk about the issue of Australian versus international investing. Justin, you mentioned a moment ago that you only hold Transurban in your portfolios. So how does each of you approach this issue of what's available in Australia and what's available in the rest of the world, and how do you manage that assessment?
Yeah. So you're right. So yes, we only have Transurban here in Australia, and it's a bit of a sad story actually. Australian listed infrastructure. If you went back into the early 2000s, maybe up until 5 or 6 years ago, there was a very good range of infrastructure companies that you could buy on the ASX. What's happened is that essentially one by one over the years, these companies have been taken over, such that nowadays it's pretty slim pickings in the listed infrastructure market for Australia. And why that's sad is not just the fact that we're based in Sydney as an Australian investor. It's more that Australia is a good place to own infrastructure. There's very strong property rights here. The governments, federally and state-based, actually, compared to what we deal with globally, are quite transparent and fair in the way that they manage these long-term assets. And the regulation's also very good. The AER, the Australian Energy Regulator, is, over the years, is a reliable and I think fair regulator for both customers and owners of these assets. So I'd love to have more of these companies listed in Australia, but unfortunately they've been gobbled up over the years, a lot of them, such that nowadays, if you're going to build an listed infrastructure portfolio, you really have to go overseas to get that diversity of asset type. And once you do that, and we're equipped as an investment team to obviously do that, and at the moment we have 29 companies in the portfolio, and 28 are outside Australia. So there's plenty of there's many opportunities overseas to invest in these types of assets. But yeah, it's Australia is not what it was 10 years ago for listed infrastructure.
What about you, Mark? You have perhaps a broader, I was going to use the word mandate, but a broader approach. I mean, do you find the same issue of lack of opportunity in Australia?
So within Australian infrastructure, I guess for illustration, if you think of any major Australian airport, it would be owned by in unlisted form, perhaps by some relatively well-known investors.
We call them,
and some of those assets, airport assets, for example, and seaports are part of the portfolio that we manage directly. We have small interests in each of those, several of those. But we think an important part of generating a sufficiently well-diversified infrastructure portfolio is to be invested much more broadly than just in Australia. So we think that the characteristics of a defensively positioned portfolio are best generated by investing primarily in major global developed markets, and Australia is an important part of that. We're focused on factors such as economic growth prospects and the rule of law that are we think found in the most attractive combinations in major developed markets in Australia, for example, New Zealand, North America, much of Western Europe. I think that diversification is a valuable part of delivering, an important part of delivering the infrastructure return that we're seeking to achieve with the appropriate level of risk.
Do we see, and to what extent does government incentivization, Justin, you talked about the Inflation Reduction Act from the US. We're talking about governments here at the lower return end, trying to encourage industry funds into socially responsible housing and into renewable energy investments. To what extent does your assessment of opportunities influenced by government, incentivization or government focus and policy?
Yeah, it's a very important consideration when we look at the companies in the different countries. It's first of all important from a risk point of view. So you don't ever want to be invested in an infrastructure company that has a fight with the government, because ultimately the government can not just take away incentives, but also make life difficult in terms of returns or investment opportunities for the infrastructure company. So we're always on the watch for, I guess, populist politicians or politicians wanting to change regulation or change the rules. And a great example at the moment actually is in French toll roads, where the government has a draft legislation to put through a tax specifically on concessions in France, which will take a piece of the pie from the toll roads, which are privately owned concessions. So there's always this risk with being a long-term asset owner.
Hey, I just contributed to the revenue stream of the French toll roads, and
right.
Good luck to the French government.
I'm glad you got in before the tax. Yeah, so that's something that it's like I see that as a core competency for my research team that we need. We want to invest in favourable jurisdictions where the rules are clear, where we have got predictable cash flows. And the classic divide for us is really between developed markets and emerging markets. We invest in emerging markets a bit, like a single-digit percentage over time, but we get that reliability, that low volatility, that inflation protection is much more likely to be found in developed markets. So yeah, the risks are there with government and the government changing things. That's the first thing. In terms of the incentives, it always comes down to what the government wants, and that's why a lot of the incentives we see, like the Inflation Reduction Act in the US, is incentives to get companies or business to meet the government's objectives. And the biggest one there, clearly at the moment, is net zero by 2050 in most countries. So we look very closely at the incentives or the tax credits, that sort of thing that might be available for companies to make very large investments into long life renewable assets or power grids to enable the government. So if you're helping the government meet their objective, that's a much safer way to operate a business than if the government's trying to crack down on you, put it that way.
So to both of you now, in the last sort of few minutes of this webinar, as you now look, forward and think about your future investment prospects, what areas seem particularly of interest to you? And it's not an area, but what areas seem particularly to hold opportunities?
Yeah, well, maybe I'll lead off. I guess areas that are certainly, I guess, high profile now and sources of many of the opportunities we're seeing and have seen recently include, I guess, the substantial growth in communications, demand for communications infrastructure, such as a result of artificial intelligence, installation of 5G spectrum. Those themes are generating enormous growth in data transmission needs for our phones and for all manner of other needs, and that growth requires a good deal more investment than we've already seen in assets such as towers and satellites and data centers and so on. So we think that's part of what can be attractive, and we've made some investments in that space in the recent past. And the other area I'd point out is, I guess, commonly referred to as a broad theme of the energy transition. This includes investments, for example, in assets such as renewable energy generation, for example, wind and solar farms, as well as opportunities to reduce emissions and help to decarbonise economies, so that, for example, economies are less reliant on energy from fossil fuels and more reliant on renewable energy that, in the long term, we think will be a much more competitive energy source. And within the energy transition space, there are also great opportunities, we think, to invest in, for example, transmission networks that'll be necessary to be more capable in order to handle the volumes of renewable energy generation that'll be flowing through. And going further still, there are opportunities, and we've invested in some companies that are effectively in the business of helping other businesses to save on energy costs, and thereby present a more attractive value proposition from the perspective of their own customers. So they're key sectors and themes that I identify as important for investors now.
And Justin, for you?
Yeah, so Mark hit on some good points, and I'd agree. I mean, three of our really big themes at the moment for investment were raised by Mark in renewables, and obviously electricity grids is another huge area where we see a long pathway of growth at attractive rates of returns in both of those. But also say communications infrastructure, which for us is the cell towers, in being having the lowest level of competition. So we also see a big growth pathway in cell towers, and particularly in listed markets. A lot of the cell tower companies are off sort of, if you look over the last 12 to 18 months, they're sort of off 25, 30% in a lot of cases. So in terms of us finding long-term businesses with long-term themes, investment themes, to find a company that's, it gets very interesting when companies sell off for us. So we're seeing opportunities. In fact, about 15% of our portfolio is in cell tower companies at the moment. I'll add two other ones that to that mix. One sector that coming out of COVID, and we still think it's a good idea, is in the toll road space. Toll roads are still seeing traffic levels, cars and trucks increase around the world. we think there's a bit more to go there, and also tolling increases, not just the CPI ones, but some of the dynamic or discretionary tolling that we might see in Canada and the US, that'll come through next year, we think. So there's some attractive toll roads to invest in globally. And the other theme that we like is water. We have a couple of countries. We have water companies in Chile and the UK at the moment. And we're seeing, with water being a scarce resource, it's extremely defensive, obviously, and impossible to substitute in the real world. There's some good investment opportunities in water networks as well. So that's one other sector that we really like at the moment.
And so, look, just one final point, one final question to both of you. We've talked about infrastructure and its role in the development of economies and in the way economies are developing. So for each of you, this is sort of analogous to the developer versus property owner question. Do you see yourselves as funding development, or do you think about funding development of infrastructure, or do you see yourselves as an acquirer of infrastructure assets that somebody else has built?
Well, I'd say a little bit of both. So, for example, in the fund that we manage directly, we're invested in, substantially more invested in assets that have been mature assets for some time, albeit in many cases they have prospects of future growth and capital needs that we would potentially like to fund. But we're also invested in some assets or opportunities that are really at a much earlier stage of development. So, for example, assets that have been perhaps have reached perhaps construction approval stages, but have not yet been begun to be built or to be constructed. So, in other words, they're quite a way off actually becoming operating infrastructure assets that are valuable to the users. So, for example, there's an airport terminal investment that we've made in North America that is where we've allocated the capital, and that is going to be drawn down as and when required to fund construction of a new terminal at an airport. That over a period of time, that will then go on to be, we think, a successful investment with at a high-profile airport terminal in that part of the world, and make a valuable contribution to that city's functioning that isn't in place now. So we are, in my view, certainly interested acquirers of existing infrastructure assets, as well as ready and willing to fund attractive new prospects too.
Justin, what about you? I mean, you talked about the 250 billion of per annum capital in your focus group companies.
Yeah, that's I mean, that's probably my favourite slide. I like that story. That very, very strongly we see the best opportunities where the existing infrastructure company is able to find investments into their existing network, or maybe it's a toll road company building a new toll road. That works as well. But we like to invest in, because that's your lowest risk way to invest $1, is to invest into your own network. If you own a monopoly and you invest $1 into it, you understand it, and also you can get the best rate of return, we think, out of that on a risk-adjusted basis. So very strongly want, and the companies are not wanting for opportunities. I mean, 10% of market capitalisation on average across our investment universe being spent in organic investments into their existing businesses. There's plenty of opportunities there for the companies. So very strongly prefer companies that are doing that as their strategy. And we expect this is exactly the sort of thing we talk about when we meet the management of the companies. For the listed companies, it's a bit hard to go and buy new assets, either listed ones or unlisted ones. I don't see much for listed companies. It's a bit hard. The prices are not as attractive as actually investing in your existing assets. So I'll have a preference for organic investment.
Great. Look, thank you very much. So Mark Murray from Mercer's, Justin Lannen from Maple Brown Abbott, thank you very much for a fascinating overview of what is really one of the fundamental investment areas for all economies and for investors. Thanks for your time, and I'll look forward to each of you who's joined today's webinar in joining us again on Friday, where we have two portfolio management companies talking then about the role that they see for property and infrastructure in a diversified portfolio. So Justin and Mark, thanks very much for your time.
Thanks so much, Toby. Thanks, Mark. Thanks, everyone.